Hello traders, welcome to this lesson on bearish mitigation block. First off, I have this written on here for you guidance through the lesson to help us understand bearish mitigation block, how to identify it, how to trade it, the step-by-step approach, and how to maximize profits once the setup has been identified. First off, we'll start with the definition, which is quite written here. Bearish mitigation block is a specific price zone that forms after a failed attempt by the market to continue an uptrend. Now, let's look at this. The market has been identified to be making higher highs, higher low, higher highs, and higher low. Only for this one, instead of continuing to make higher high, we failed to make the higher high, and then next thing, market went down. See, when the market goes down like this, impulsively over this level here, that's where we've identified our setup. And instead of the market continuing, instead of the market continuing higher, that making not higher high, you need an impulsive move downward. And then you will now wait for the moment when the market comes to that last block here, right here. When the market comes here, that's this block that failed to make the higher high. When the market comes here, we look forward to taking our trades. We need to look for it to go down. That's what it is. The market was making this a higher low, higher high, higher low, higher high, higher low. And instead of making another higher high, we broke down here. It failed to make the higher high. Only for it to make lower low. Now, if it makes a lower low, it's advised that do not chase price patterns. Once the market breaks down through this level, you see it has only failed to make a higher high. This one we wait for a setup to come in. It falls down to this level impulsively. Then we wait for it to come back to this level. This last bullish candle that formed there, that failed to make that higher high. This last bullish, wait for it. Once the market comes down here, this is where you start looking for your setup. You start looking for pin bars to show that the market is actually going down. Now, if you have identified the failure to make higher high, which is the bearish mitigation block, the market moves impulsively down. What you are wait for, you patiently wait for the market to come to this place and then showing some kind of a bearish engulfing candle to tell you that this market is pulling down. Bearish a pin bar. Look keenly. That's what a set of funds. Look keenly to see that the market shows an engulfing candle, or maybe a pin bar to show that this market is not ready to go higher anymore. Now look for the try this impulse move. We should work out as well for some kind of fair value gap around here. Once that impulse move downward is made, if we want to identify that this is the failure to make a higher high, look for fair value gap here. At this point here, wait for patiently for the market to get to this point. This will enter for shots. Stop loss should be above this high in order to save your capital. Strategically, you place your stop loss here. Then wait for the market to bring in the profits. There is nowhere else to trade bearish mitigation block other than what you've just seen here. What gets making higher high and then you fail to make a higher high. Look for it to make an impulsive move downward. Breaking through this low here. Okay, that's better through the low. Now not patiently wait for the market to come back here. And then trust some kind of confidence that will tell you, okay, this market is really making a higher high. That's where you take your shots. That's why you take your sell trade. Well, the angle now it can be better with this is often of the lecture and everything is continuous backtesting as traders. So you chose this line, it's continuous backtesting, known affecting your strategy. But perfecting your strategy, they always see it forming over and over at specific times in the charts. Then yes, now you have a strategy. You now have know how to harness that strategy. We can look at it through multiple asset classes. Now I'm going to go to this trade on gold. Let's see how this thing forms here. This is a 15-minute chart. Yesterday was Friday and we're counting on MFP. Some kind of FP, I think a non-farm hero change. But somehow the government shut down and that the news wasn't out, so the charts were scattered. I was basically counting on US Tech to print a particular setup, but the second month wrong that I didn't go through. Now we can look at it. Today is the 4th of October, but if you look at what happened on the yesterday, which was Friday, heck, you see what the market didn't just go anywhere. It was moving choppy, moving up and moving down. The news wasn't released. Well, I guess that's it. Then this one was practically what happened in gold. Look at the market here, making higher highs, higher lows, higher highs, higher lows, higher highs, higher low, and then it took out. And now, so there's an important keynote that I forgot to tell you about. A sweep of liquidity, continuous sweep of liquidity makes your setup a high probability. It's better when a liquidity is swept and then you see bearish mitigation forming. That's when you know, okay, these institutional sellers or buyers are in the market now. You see the bearish mitigation forming. Or what you have to do, look at what happened here. See, the monthly high, look at this candle. It took out set of liquidity on the past day, and then I think it was on the higher order of Thursday, took out the liquidity, bit of liquidity there, and then it dropped down. Now, was this candle, this was the candle I was looking at. Was this candle I was expecting this handle to take off to make another higher high, only for it to move down low. Now, there was down so loud. We didn't move down so loud. The post impulsive momentum downward wasn't so elaborate. And this one came down to here. It's sort of I could do it take a sell. But then look at this other candle here. This was a candle that was broken. Then after this candle broke down, because this one made a high, then this one couldn't make anything, only for this one to take out that liquidity and then drop. This was what I was looking at. I looked at this particular candle that was the key entry point. Key entry point for all traders, all institutional traders, just the key entry point. Once it took liquidity through this point, you see the market drops down. That was 4.14 RR. But of course, I don't expect it to stay all through the market waiting for $100 to become $414 move. If no, right through this level here, once it gets through to this level, I expect you to size down, remove your capital, remove some part of your capital, and then on carry up. Right, why you adjust your stop loss. We are not going to go through that right now on this lecture, how you are going to size down and do, because it might make the lecture longer and it will get longer. No, the risk management is very important, paramount in any trader's arsenal. Any trader's arsenal, you have to manage your risk. Once the market goes to the desired direction, and we lose 50% of that level. One was anticipating, here is the reason why I was anticipating the market to break down after session has run through. It was making this session, it was running through, making higher highs, higher lows, higher highs. Then one came down. Look at why I was anticipating this market to break down. I missed because the price hasn't been balanced yet. The random session consolidated up to the session and then it's run off high. While the market is going high, I see from my back testing that somehow it gets to level here, it has to come back and balance the price range. And this is what happened. You see, this is the round of which we're looking in from the session up to the London session. When it made this high, then it broke down. And we were at a particular time when the stocks are opening, and without the news anticipated news, We saw traders wire forward in the market. So choppy pairs were running up and down. But this is just what a bearish mitigation block is. You see, the market comes to this place, it prints same thing again. Run a higher high, taking out the liquidity of these highs. They took out the liquidity of this high, and then it came down, it ran down, Here you can see a breakup block from it. But then look at this place. You see, this is a female swing again. A female swing. This is an important failure swing. Then if you had taken a trade, let me remove this so I can see it better. If you are taking a trade from this one, I cost that female swing. Look at it. You still have, well, look for the last bearish candle that failed to meet that higher high. Vote for the impulsive break lower. If it breaks lower, then vote for it to come back to the upper. If it's bullish, this is a bullish candle here. If once the market comes to this level, that's why I'm going to look out for those setups, for those green candles, those candles to show like maybe bearish engulfing candle or penny bar showing that this market is going low. That's where you take your trade. Well, strategic stop loss is above this high. Through the much back testing I've done, but you have communication to do own back testing as well. Proper back testing and learning, it's only what grows a trader's confidence. Thank you guys for your patience. I hope to learn from you soon to share what your back testing gave you. If you have any question, please feel free to throw it up. I'll be happy to hear what your questions are.